Welcome to today's explainer. Look, you've spent decades, literally thousands of hours of your life, working hard, saving diligently, and building up that nest egg of yours. And first of all, congratulations, because that is no small feat. But now that you've actually reached this incredible milestone, well, the rules of the game, they're completely changing. And that brings us to the most crucial question you're facing right now. Where should you invest your money today so that it actually lasts? You see, for years, your only goal was simply accumulating wealth, right? But now you're transitioning into a completely different phase of life. You've got to shift from putting money away to actually living off of it securely and doing it without constantly looking over your shoulder. Because let's be honest, there are 4 things that keep almost every retiree up at night: running out of money, devastating market crashes, that silent thief we call inflation, and skyrocketing healthcare costs. If you've worried about any of these, trust me, you are completely normal. But here's the good news. We do not have to operate on fear. Today, we're going to replace all that anxiety with a structured, highly optimistic approach to your portfolio. So, here's our roadmap for today. First, we'll cover the retirement mind shift. Second, building a safe foundation. Third, generating reliable income. Fourth, growth and diversification. Fifth, we'll look at a sample retirement portfolio. And finally, number 6, the costly mistakes you absolutely need to avoid. All right, let's jump right into section 1, the retirement mindset shift. This right here is where we lay the groundwork. Because honestly, the strategies that got you to retirement, they aren't necessarily the ones that are going to get you through it. Your strategy absolutely has to change. Think about it. Pre-retirement is all about aggressive growth, right? You have the time to just ride out those market dips. But in retirement, the whole focus pivots. It becomes all about preservation of wealth and generating dependable income. Now, you still need to outpace inflation for sure, but you really have to balance that growth with a solid safety net. Simply put, you're no longer in the accumulation phase. You are officially in the distribution phase. Moving right along to section 2, building a safe foundation. So I want you to think of this foundation as the bedrock of your financial house. It's your safety bucket, where securing your money is literally the top priority. And the very first tool in our foundation, the high yield savings account. This is your emergency cash. It's highly liquid, meaning you can pull it out tomorrow if, say, your roof springs a leak or you get a sudden medical bill. Plus, it's FDIC insured, so your principal is completely protected. And hey, especially in our current interest rate environment, these accounts are actually paying out a really respectable yield, which makes them just an excellent place to park the cash you might need right away. Next up, let's talk about certificates of deposit, or CDs, and a highly effective little strategy called laddering. Because instead of locking all your money into a single 5-year CD and just losing access to it, you build a ladder. Here's how it works. Step 1, you buy a 1-year CD. Step 2, you buy a 2-year CD, and so on. Then, when that very first CD matures, you simply reinvest it at whatever the current rates happen to be. It's brilliant because this gives you fixed, safe returns, but it ensures you have money freeing up on a regular basis. So you're never entirely trapped if interest rates suddenly spike. Now, to finish off our safe foundation, we look to the U.S. government. Alongside your standard Treasury bills and bonds, we have TIPS. That stands for Treasury Inflation Protected Securities. Because they're government-backed, they are incredibly safe. But the real magic trick here is that their principal value actually adjusts upwards as inflation rises. So it's just a fantastic foundational tool to make absolutely sure your buying power doesn't slowly erode over time. All right, that brings us to section 3, generating reliable income. Okay, now that our foundation is nice and solid, let's look at the bucket that's designed to act like your brand new paycheck. First up in the income bucket, we have bond funds. Now, instead of you trying to go out and pick individual bonds all by yourself, bond funds actually pool your money to buy a massive, diversified collection of thousands of government, investment-grade corporate, and municipal bonds. What this does is generate a very steady, very dependable stream of income for you. Now, I should mention they aren't entirely without risk. For instance, if interest rates go up dramatically, bond fund values can take a dip. But for steady income generation and getting some diversification away from stocks, they are an absolute staple for retirees. Moving from bonds over to equities, we have what I like to call the royalty of the stock market, dividend aristocrats. So these are massive, ultra-reliable companies that not only pay dividends, but they have a proven, documented track record of consistently increasing those dividends year after year, decade after decade. They provide just wonderful passive income and long-term appreciation. But a quick word of caution here, relying on just 2 or 3 of these companies concentrates your risk a little bit too much. And that is exactly why so many retirees actually prefer dividend ETFs, or exchange-traded funds. You'll see ticker symbols like SCHD, VIG, HDV, and DGRO. What these do is group dozens, sometimes hundreds, of these reliable dividend-paying companies all together. That gives you instant diversification, it significantly lowers your risk compared to just picking individual stocks, and it still delivers that beautiful, consistent dividend income directly right into your account. Which leads us to section 4, growth and diversification. Because look, just because you're retired doesn't mean your entire portfolio should just stop growing. You still need to beat those long-term living costs. So even in retirement, you absolutely still need calculated stock exposure. And broad index funds, like the ones tracking the S&P 500 or the total stock market, are usually the very best way to get it. This portion of your wealth is specifically designed to grow over the next 10, 15, or even 20 years to make sure you never lose your purchasing power. You simply tailor the size of this slice of the pie to match your own personal risk tolerance. Another really great diversifier is REITs, or real estate investment trusts. Look, let's be real. Nobody wants to be out there unclogging toilets at 2 a.m. in their retirement. Am I right? Well, REITs give you exposure to real estate growth, and they pay out regular monthly or quarterly dividends, all without you having to manage any physical properties yourself. Just keep in mind that, much like bonds, they can be a little sensitive to shifting interest rates. Finally, in this section, we've got to talk about the wild card of the group, annuities, specifically immediate and fixed annuities. Now, I know they can be pretty polarizing, but let's just look at them objectively for a second. The massive pro here is guaranteed lifetime income. It is literally a paycheck that you cannot outlive. But the cons? Well, they often come with high fees. Inflation can really eat away at those fixed payments over time, and you generally lose control of that initial lump sum of cash. So they aren't for everyone, but if you are absolutely terrified of outliving your money, they can actually be a very appropriate specialized tool. All right, let's bring it all together in Section 5, your sample retirement portfolio. So we've looked at all the individual pieces, right? Now let's see how all of this builds into a cohesive strategy. When we put this all together into a classic, balanced, educational example, we get a 6-part strategy. We have 20% in cash and high-yield savings for that quick liquidity, another 20% in treasuries and CDs for that rock-solid, safe foundation, then 25% in bond funds for your core income, and 20% in dividend ETFs for income with just a little bit of growth. Finally, 10% in broad index funds for the long-term growth and 5% in REITs for some extra diversification. Now, please remember, this is just a sample. Your exact allocations have to be adjusted based on your specific age, your health, and your personal income needs. But this gives you a great visual of how these different asset classes work together as a team. And that brings us to our final part, Section 6, costly mistakes to avoid. Because even with a fantastic plan, human nature has a way of getting in the way. So let's rapid fire through some common pitfalls, because these can derail everything we just built. First, holding way too much cash. Yes, cash is safe, but over time, inflation will slowly destroy its value. Second, chasing dangerously high yields. Usually, those are just high-risk traps in disguise. Third, ignoring inflation entirely. Big mistake. Fourth, lacking diversification by putting all your eggs in one basket. Fifth, emotional investing. Panicking and selling everything during a temporary market downturn just because you watched a little too much cable news. And finally, number 6, failing to rebalance your portfolio once a year to keep your strategy on track. You gotta stick to the discipline, folks. So our core philosophy today is actually pretty simple. There is no single magic bullet investment out there that does everything perfectly. The most successful retirees, the ones who really thrive, combine multiple asset classes to balance safety, income, and growth. And that is what ensures true long-term financial security. I really want you to take this quote to heart. There is no single perfect investment. Focus on dependable income, capital preservation, diversification, and steady long-term growth. It is all about balance. I strongly encourage you to review your own retirement plan regularly. And hey, if you're ever unsure about any of this, consult a fiduciary financial professional to get personalized advice tailored to your exact life situation. To wrap things up, I want to leave you with a bit of a provocative question to chew on. Take a good look at what you own right now. Is your current portfolio stubbornly built for yesterday's aggressive growth, or is it intelligently designed for tomorrow's security? Think about that. If you found this explainer helpful and you want to make absolutely sure your money lasts as long as you do, hit that subscribe button for more retirement, dividend, and personal finance strategies designed to help you retire with absolute confidence. Until next time, keep learning, keep planning, and take care of your financial future.